Welcome back to the deep dive. We're jumping into AutoZone's third quarter results.
Yeah, the numbers for the period ending May 10th, fiscal Q3 25.
Exactly. Overall sales climbed 5.4% to $4.5 billion. Comps were up 5% here in the U.S.
And 8.1% internationally if you adjust for currency.
Right, constant currency. But the earnings per share did dip a little, down to $35.36.
So a bit of a mixed picture. Let's unpack it.
Okay, so that 5% domestic same-store sales. What's behind that number?
Well, it's interesting. The DIY side, do-it-yourself, that grew just over 3%. Actually, the best they've seen since Q2 of fiscal 22.
Okay, so some improvement there.
Yeah, but the real story, I think, is the commercial side. Pro customers.
Ah, right. How did they do?
Up 10.7%. That's their first double-digit growth since Q2 of fiscal 23. Pretty significant.
Wow, 10.7%. And they mentioned crossing a threshold too, didn't they?
They did. Over $5 billion in commercial sales now on a rolling four-quarter basis. That's a big milestone. Shows they're really making inroads with the pros.
Definitely suggests that strategy is paying off.
Yeah.
Now, did the sales pattern hold steady through the quarter?
Not exactly on the DIY side. They said it was influenced by a few things. Timing of tax refunds.
Yeah.
Cooler, wetter weather in some parts of the country, and also the shift in the Easter holiday.
Right, that always complicates year-over-year comparisons a bit. The commercial side.
That seemed more consistent. They noted pretty steady growth across all 12 weeks for commercial.
Okay, so the pros are reliably buying. Let's switch to international then. 8.1% constant currency growth sounds strong.
It does, yeah. That's Mexico and Brazil performing well underneath. But, and this is currency exchange rates were a major headwind.
How big?
Well, the Mexican peso, for example, weakened almost 20% against the dollar compared to last year.
Ouch. So what did that do to the reported international numbers?
It completely flipped them. The unadjusted international comp was actually negative 9.2%.
Wow, that's a huge swing.
It is. It meant an $89 million hit to total sales, $27 million less in EBIT, and about $1.10 per share drag on EPS.
Really highlights those global economic pressures, doesn't it?
Absolutely, even if the underlying business is doing well in local currency.
Okay, coming back stateside, you mentioned the commercial growth. Did transaction volume increase too?
Yeah, commercial transactions were up almost 9.8% domestically. So it's not just higher prices, it's more actual business.
Good sign. And what about traffic on the DIY side? You said sales were up just over 3%.
Right, and the traffic actually improved too. It was up about 1.4%.
Yeah.
Compare that to last quarter when it was down 1%.
So maybe gaining a little share there, or just bringing people back in?
Could be a bit of both. Definitely a positive sign after the previous decline.
Okay, so top line looks pretty robust, especially commercial. But let's talk margins. Gross margin slipped to 52.7%, down 77 basis points.
Yeah, just under a percent drop there. Several things fed into that.
Right.
Well, domestically, they had higher inventory shrink. Theft, damage, that sort of thing.
Okay.
Also, just the mix effect. As commercial sales grow faster and they have slightly lower margins than DIY, that pulls the average down. That happened domestically and internationally.
Makes sense. Anything else?
They also mentioned startup costs for new distribution centers here in the U.S., and there was an $8 million negative non-cash LIFO impact.
Right, the accounting for inventory costs. That hit them for about 21 basis points on its own.
Exactly. So a few different pressures there. On the plus side, though, their actual merchandise margins improved.
Ah, so the core profitability on the parts they sell is still solid.
Seems so, yeah. That helped offset some of the other drags. It's a complicated picture.
It definitely sounds like it. They also mentioned a LIFO credit, though, related to freight.
Yes, $16 million LIFO credit this quarter because freight costs have come down. But they also said there's only about $3 million left in cumulative charges to reverse.
And they don't expect more credits in Q4.
That's what they signaled, yeah. Looks like that particular tailwind might be mostly over.
Okay. Let's shift to operating expenses then. They rose 8.9% year over year. That seems pretty high.
It is a significant increase, and it meant their SG&A, selling, general, and admin costs deleveraged, went from 32.2% of sales last year to 33.3% this year.
So expenses grew faster than sales. Why the jump?
Couple of main drivers. One was higher self-insurance expense. They linked that partly to the commercial growth, more delivery vehicles on the road, and also settling some older claims.
Okay, that makes sense with a commercial push.
The other big piece is investment. They're spending more on their growth initiatives, building out those hubs and mega hubs, investing in technology to support everything.
Right, spending money to make money, essentially. investing in future growth,
That seems to be the rationale, but it does impact profitability in the short term.
which we saw in the numbers. Operating profit down 3.8%, net income down 6.6%.
And that diluted EPS down 3.6% to $35.36.
But again, we have to factor in that currency effect,
Yeah.
right?
Absolutely. If you strip out those FX headwinds, they said the EPS decrease would only have been 0.6%.
Much smaller impact.
Yeah,
Really shows how much those currency swings mattered this quarter.
definitely. So let's talk more about those growth initiatives they're investing in. The hubs and mega hubs seem key,
Yeah, they opened 8 new mega hubs in Q3.
right? Brings the total to 119, and they plan at least 10 more next quarter. These bigger stores seem to be working well for them.
How so?
Management said they have faster comp sales growth than the regular stores, and they're crucial for getting parts out to the whole network, especially for commercial.
And the long-term goal.
Just under 300 mega hubs eventually, so still quite a ways to go on that build-out.
And they're still opening regular stores too.
Oh yeah, 54 new ones in the U.S. this quarter, 25 in Mexico, 5 in Brazil, net increase of 84 stores.
Wow. There are over 7,500 stores now, total.
Yep, 7,516. And they're aiming for about 100 international openings for the full fiscal year, still expanding the footprint quite aggressively.
All this expansion costs money, obviously. What's the capital expenditure outlook?
They're guiding for about $1.3 billion in CapEx for fiscal 25.
That's going into.
New stores, especially those hubs and mega hubs, plus new distribution centers they just opened too, California and Virginia, and tech investments.
So a lot of investment aimed at strengthening the supply chain and delivery for commercial.
That seems to be a major focus, yes. Better execution, better parts availability, faster delivery for the pros.
Okay. What about inventory levels with all this growth?
Inventory was up 10.8% year over year. Part of that is the new stores, part is stocking up for the sales initiatives.
Per store.
Inventory per store rose 6.7%. But their net inventory, what they owe suppliers actually improved slightly per store. It's still negative, but less negative than last year.
So managing it okay despite the buildup?
Seems that way. They also kept buying back stock.
Right. Share repurchases. How much this quarter?
Repurchased 70,000 shares for about $250 million. Average price around $3,570 a share.
And they still have authorization left.
Yeah, about $1.1 billion still available under the current plan. They've bought back a massive $38 billion worth since '98.
Wow. Consistent capital return. Okay, let's pivot to tariffs. Any impact this quarter?
Management said minimal impact in Q3.
And looking ahead, concerns about new tariffs.
They seem confident. They expect their mitigation strategies, working with vendors, diversifying sources, maybe some pricing adjustments will offset potential Q4 tariff costs. They don't foresee a material hit to gross margins from tariffs next quarter.
That's reassuring. What about ticket prices long term?
They expect average ticket growth to settle back around 3% eventually. Tariffs could influence that, of course, but that's the baseline expectation.
And the overall outlook for Q4 sales?
They sounded pretty positive, expecting solid trends for both DIY and commercial, partly because the comparisons to last year get a bit easier.
Right.
And partly just the momentum they feel they have from these growth initiatives.
But the currency issue isn't going away.
No, they expect that to continue. If spot rates hold, they flagged about a $50 million drag on revenue, $20 million on EBIT, and maybe $0.80 on EPS just from FX in Q4.
Still a significant factor to watch. What did the analysts on the earnings call focus on?
Mostly tariffs, the cost structure, and whether this growth, especially commercial, is sustainable. The general tone seemed neutral to maybe slightly positive. They definitely acknowledged the better execution.
So maybe a bit more constructive than last quarter?
Yeah, I think so. More focus on the growth momentum this time. Management sounded confident about commercial growth and handling tariffs, but still, cautious about inflation and the investment needed.
And what were the key messages from the CEO and CFO?
CEO Phil Daniele really hammered the strong commercial growth, the improving DIY comps, and international performance. Talked a lot about the ongoing investments in customer service.
And the CSO.
Jameer Jackson detailed the financials, kept highlighting the FX impact, explained the margin and SG&A drivers, expressed confidence in future growth and their disciplined capital allocation.
Did they talk about where they're getting their imports from? China specifically.
They did. Acknowledge China is a primary source, but stressed they are diversifying. They also discussed how they handle tariffs, whether through direct imports or third parties. seems like a key focus area.
Any regional differences mentioned?
Yeah, they noted DIY was a bit weaker in the South, Central, and Western U.S., but stronger up in the Northeast and the Rust Belt. So some regional variation there.
And the push for commercial market share continues.
Absolutely. They mentioned they think they have about 5% share currently, so lots of room to grow. Focus remains on improving assortment and, crucially, delivery speed for those pros.
Okay, so wrapping this up, key takeaways. Strong top line, driven by that impressive commercial growth and improving DIY. International looks good underneath the currency noise.
Right, but margin pressures are definitely there. Partly from the mix shift to commercial, partly inventory shrink, and significantly from the strategic investments they're making, plus those FX headwinds.
That double-digit commercial growth really does feel like the headline number, though. And the heavy investment in hubs, DCs, tech, it points to a clear strategy.
It does. They're betting that building out that infrastructure will drive future growth and let them grab more market share, especially from the professionals.
But it's complex.
Yeah.
They're juggling those investments, potential tariffs, currency swings. It's a lot to manage.
For sure. It's not a simple picture.
So maybe the thing for you to think about is this. As AutoZone keeps pouring money into its network and really goes after that commercial business, how is that going to change the game for competitors? And what new kinds of value could they potentially unlock down the road, both for the mechanics and for the DIRs still fixing things in their own garages?
Interesting question. The competitive landscape could definitely shift.
Something to keep an eye on. Thanks for diving deep with us today.